Hello students, this is Dr. Wang here recording. In this video clip, we're going to study chapter number 1, and this chapter is about the basics of financial concept, and we will discuss the role of managerial finance throughout the chapter. So first, let's get to the learning objectives. So we have different learning goals. We will first define finance and the function of finance, and then we will introduce the legal forms of business organization in this country, which include sole proprietorship, partnership, corporation, limited liability company, and so on. We then talk about the goal for a firm to exist. The goal, of course, is to maximize shareholders' wealth. However, the shareholders may be selfish, so there could be a conflict between the principal, which is the shareholder, and the agents, which are the managers. So that's called an agency problem, and we will learn how to solve agency problems in different methods. We will also address the job opportunities in the financial industry, as well as the primary activities of the financial manager, and also we will talk about the relationship between finance and economics, between finance and accounting. So finance is a subject which is a science and art of managing money, and it concerns with a lot of individuals because as human beings we need money to survive, and we need to know how much we earn and how much we spend, and then we need to know how much we need to save in order to have a long-term plan with a sustainability. In a business context, the finance would involve raising capital from investors. So if you want to run a business, you cannot just rely on the money in your pocket. You need to attract investors either by borrowing or raising equity. And after you make some money, you need to know how to invest the money in order to get some profit. And after you make more profits, you need to decide to reinvest the profit in different business routes. The financial service industry is based on those ideas, and that industry is designed to deliver advice and also produce financial products to individual investors, businesses, and also government. So if you want to find a career in the financial industry, you could work for a bank either as a banker or underwriter, or you can be a consultant for personal financial planning. You can also be a professional as a fund manager to do decent investments in terms of generating return and limiting risk. You can also flipping house in the real estate industry, buy a house or a commercial building with a lower price, hopefully renovate it and sell it at higher price. You can also take a step in the insurance industry. Right now in the United States, the insurance industry is very lucrative. The gross profit margin is very high in this industry. So the managerial finance is the center of this class. So we will need to know the duties of the financial manager. And for financial managers, they not only administrate the financial affairs such as cash inflows and outflows, managing credit, capital budgeting, and also they are in charge of collecting, disseminating, and consolidating the financial information. And financial managers can play a role in private and public companies, profit or not-for-profit organizations. So that's their job. So what kind of certificate can you get as a finance professional? So you can get a CFA, Chartered Financial Analyst, and the CFA would cover 7 to 8 subjects, including accounting, ethics, portfolio management, economics, and so on. And the CFA is pretty tough to get because you need to take the exam at 3 levels, and it is a process that could take, normally speaking, 3 years to do it. Another certificate which is easier to get is a CFP, or Certified Financial Planner. You can pass a 10-hour exam with a wide range of topics related to financial planning. So based on the CFP, you can be a consultant, either working for a fund company like Edward Jones or Charles Schwab. So here are the popular positions in the financial industry and the description of their duties. So we have a financial analyst here, capital expenditure managers, project finance, cash manager, credit analyst, and pension fund manager, foreign exchange manager. Actually, there could be a lot more positions like hedge fund manager, the arbitrager or traders in the financial institution. You can be an underwriter for investment bank or a trader for options and derivatives, and also many other jobs. Okay, so here comes to our first topic, um, which is related with the major forms of a business organization in this country. So we have a sole partnership. Basically, that is a business owned by one individual, and he or she may have a certain talent, like performing a yoga or doing plumbing work. So then she or he could establish a company under name. The second one is called a partnership. Basically, it's pretty much like a sole partnership on the top. The only difference is it is owned by two or more people, and the profit could be shared on a pro rata basis. Depending on how much equity you have in the business, you get how much profit in percentage. The next one is called a corporation. It is the entity created by law, and you have to follow the corporate law and wield the powers of U.S. corporate law to protect yourself. And a corporation is just like a individual. It can sue or can be sued, and it can make contract with other parties, and also it can acquire its own name. So what's the difference between these three types of businesses? So right here we have sole partnership, as I said, is owned by one person. Partnership is owned by two or more people. And between the partnership, there will be a legal arrangement between the partners, and the firm's income is allocated on a pro rata basis. So pro rata basically means proportional. If you have a 20% of the equity, then you get a 20% of the income. You may not contribute 20% of the money to start the company. You may be a talented person doing all the work and come with no money, but you can always discuss how much equity you should have with another financial partner who comes with loads of money. And for these two types of businesses, there's no corporate tax. They just pay income tax. So that's very important to know, because it's also easy to know because these are not corporations, so they don't pay corporate tax. When they make money, they just pay income tax. So what are the advantages and disadvantages? First of all, for this partnership and partnerships, there is unlimited liabilities. Unlimited liabilities indicate that the liability is not limited to the investment in the company. If your company is worth $10,000, but you have $1 million in debt, then you have to pay back all $1 million, whether you liquidate the company or not. So you may sell your company to pay 1% of your debt, but you still are responsible for the rest 99% of the debt. You may have to sell your own personal belongings, your cars, your houses. You may have to sleep on the street to pay your obligations, to pay your liabilities. So that's called unlimited liabilities. And also, as a partnership and partnership, the life is limited. If the owner died or quit, then this partnership will not exist. It cannot last for a long time. And also, it is very difficult to transfer ownership. You have to find the right person who has the right interest and willing to give the right money for the right amount of shares of the business. So you can see that's going to be very tough to find another person to sell your equity to. And also, it is difficult to raise large amount of cash Just because ownership is hard to transfer, you cannot just find a lot of buyers, so it's also difficult to attract investors from those buyers. So what are the advantages? The advantages is that there's less regulation, so you just go to the Chamber of Commerce of your city and get yourself registered, and then your business just comes to being. And you don't have to follow corporate law. Basically, you just run your firm on the normal basis. And also, there's no corporate tax, as I mentioned earlier. Now let's discuss a corporation. So the corporation got the advantages of raising large amount of cash. For example, the Apple Incorporated. This company was founded by Steve Jobs and his partner in their garage back in the 80s, and it was a partnership at the beginning. And then they want Apple to grow large. So the one way to grow large, of course, is to attract enough capital. Therefore, Steve Jobs and his partner convert the form of the business from partnership to corporation. And then they could get access to the capital market, and their shares could be divided, sliced into small pieces, so investors across the entire globe could buy their shares. So that's the story of Apple. And also for corporations, the liability is limited. So if the company has $1 million debt, but the company is only worth $10,000, so what would happen is you just need to sell the company for $10,000 and then get the $10,000 to pay back part of the debt. So what about the rest 99% of the $1 million debt? So it's gone. You are not responsible for it. Your liability is limited to the investment, to the worth of the company. And also, a corporation has a perpetual life. Perpetual basically means forever. Just because the ownership, the stocks could be transferred from one to another, from one generation to another generation, so it can last, technically it can last forever. Like Steve Jobs, the original owner of Apple, although he died, Apple is still surviving. All right, so what's the disadvantage here is a double taxation. The corporate would pay corporate tax for sure, and it's not because corporate tax at a percentage is higher than income tax. In some circumstances, income tax rate could be higher than corporate tax rate. But for running a corporation, you are paying two taxes. One is a corporate tax you pay after interest is paid before the owners get net income. And another tax is paid based on the net income distributed to the shareholders. Well, in your financial accounting class, you have learned that net income could be paid as dividends, and then that would be subject to dividend tax. And also, if dividend is not paid, stock price would increase, and the owner would make a capital gain from a price appreciation. Then that's capital gain tax. So one way or another, the shareholders would pay tax on the net income after corporate tax is paid. Realizing that problem, well, we see double taxation would discourage corporations. So the U.S. Congress has passed a bill to form this S corporation or small corporation. So this S corporations is a way to encourage small businesses. They do not pay corporate tax. Instead, they only pay income tax, and they are taxed as a partnership. So that is a big relief of tax load for small businesses. And we also have these forms of businesses that are called a limited liability company and a limited liability partnership. So these forms of businesses usually have smaller size, and they are more professionally in the accounting, law, and architecture industry. So they take a pretty delicate forms, and they're hard to establish. Okay, so these are like a hybrid between a partnership and a corporation, and enjoy the benefits of both sides. They don't pay corporate tax, so there's no double taxation. They have a limited liabilities, and the ownership could be transferred. So right here is a table showing you the strengths and weaknesses, pros and cons of these three types of businesses. And I think this is a good way for you to study. And in your test, definitely I'm going to give a question on the content of this table.